Hey everybody, this is Damon Moore. I'm here with Fron Neal, a mortgage broker for NRL Mortgage. How are you this evening?
I am great. Thank you for asking. It's great to be here.
Uh, Thank you for taking some time to talk with me. What I want to do is kind of go through a few questions, some things that were on my mind, and some other questions that people were asking me about the mortgage process, and let's see if we can kind of provide some information that may be helpful for future home buyers. So, what's your role in the process of helping a person find a home?
At this time, what I am doing is I'm assisting the buyer to acquire financing to um, to purchase the home, and then walk them through the steps of acquiring the house from the financial point.
What does that mean? The process of buying the house from the financial point.
Uh, that would mean you being pre-approved initially, um, doing a credit review, making sure that once you select the house, you've been pre-approved, and then walk you through the necessary steps um, to get to the closing table.
So the pre-approval process. So does that mean, okay, so I'm trying to buy a house.
Mhm.
Uh, I come to you, I say, hey, I want to buy a house. I You're saying you put me through some kind of pre-approval process or procedure?
Basically, what it is that we will walk you through a pre-approval process, which in short makes the determination of your credit, your income, your job stability, as well as your assets. And once we have deemed that those items are in line with being pre-approved, we will then issue a pre-approval letter. From that point, that gives you the green light to go and do shopping for your home, making sure that everything matches up. Once you've received that home and the realtor has sent me the contract, I will then begin the process of making sure that everything that we had on the initial consultation matches up. That means that you have your supporting documents, your 30 days of pay stubs, your 60 days of bank statements, the W-2s for the last 2 to 3 years, or 1099 tax returns, things of that nature, all match up to uh, make sure that this is going to be a house that you are going to be able to afford. Once we go through that process, then we go and send you in front of an underwriter for the lender of that company. The underwriter gives you a final or an approval based on conditions. Those conditions may be understanding a little bit better about your income, trying to figure out exactly where the sourcing your funds for the assets portion of it, and making sure that there's all of the credit requirements are being met. Then they take a look at it a second time to prepare you for final approval, which basically gives you, they check it against the guidelines and make sure that everything is nice and wrapped up in a nice little tight package. And then at that point in time, they prepare you and give you the final approval, which is um, a very happy time at that point in time for everybody that's involved, um, because they've issued a clear to close, which then goes over to the title company to finish their portion of the transaction.
It sounds like a lot. Does a person need a mortgage broker?
They don't necessarily need a mortgage broker, but to acquire a mortgage, yes, they do. If they have cash in pocket or cash on hand to go and make that purchase, then in that case, yes. But for that buyer to acquire a mortgage, they would need the assistance from a mortgage broker or a lender of some sort, a banker that specialize in real estate.
Okay, so I think earlier you said if the person has cash on hand, then yes, but I think you were saying that if they have cash on hand, then no, they don't need a mortgage broker. Is that
That is correct.
okay?
That is
All right.
correct.
Okay.
Yeah.
Um, so so a person who needs money to acquire the home, if they're going to use that, I'm sorry, let me ask the question a different way. So if a person needs money in order to acquire a home,
Mhm.
and they're going to fulfill that need by obtaining a loan, then it's the mortgage broker that helps them find the mortgage. Is that
Absolutely.
okay? Okay. And why use your particular company uh,
Mhm.
as opposed to, let's say, going to Chase Mortgage or going to um, uh, some to a person's bank, for example.
Okay. And which is a fair question, and thank you for asking that. Um, One thing that NRL Mortgage really specializes on is speed to close. We boast um, a closing rate of roughly about 21 days. In some cases, they have been earlier where we've turned them around in exactly 15 days.
Wow.
And it just depends on how well the file reads to the underwriter and how much sense it makes. We've gone all the way down to 9 days, where the appraisal, we're just waiting on our appraisal to come through for that transaction. So overall, speed to service, and then also the service from me as being the mortgage loan officer. A lot of your banks have normal times of 9 to 5, 8 to 5, 10 to 5, you know. But me as being a mortgage broker, my time frames are as early as 8 in the morning, all the way to 9 p.m. So if you have a burning question at 7:59 and the banks are closed, I will be available to answer either via email or text, or in some cases, have a full scale conversation with you.
How do you help determine which type of loan is best for a person?
Well, normally, what we would do is upon the credit review, once I'm going through the credit with the borrower, we look at the FICO scores. The FICO score that we measure things or measure how that the program would work for you would be based on your score. For example, if you're at a 660, um, there's two ways that you can actually go. You can either go with conventional with certain circumstances, but mainly we would probably put you in an FHA loan. A FHA loan would give you a little bit more leniency as far as your down payment. The FHA administration actually regulates things and are more kind to home buyers who have those type of scores at 660. If you were like 720 or greater, we would go and look and explore, just depending on the other factors of being pre-approved, a conventional loan. With the conventional, most of your clients are between 5 and 20% ability to put down. Their credit is a little bit stronger, so they may have a little bit more leniency as far as the products that's associated under that conventional those conventional guidelines.
What's the difference between a fixed interest rate and an adjustable interest rate, and when is one better than the other?
Okay. And the fixed interest rate and adjustable interest rates, it just depends on the needs of the buyer in that situation. Fixed interest rates, basically, that interest rate, the principal and interest from that mortgage will not go up, it will not go down. It is as like it's mentioned as a fixed interest rate, period, point blank, between 1 to 30 years. The only thing that you would have to worry about in this situation would be the increase of the mortgage or the property taxes or your homeowner's insurance. An adjustable rate mortgage usually has a tendency to start at a lower interest rate, but it maxes out. It max out at a certain percent number. So, for example, you may start off at a 2.5% interest rate, but once the loan fully matures, you're looking at an interest rate at 6% or 5%. It just depends on what the environment and what's cost or what's called for.
But when would one be better than another?
A circumstance that may be ideal for an adjustable mortgage rate is an individual who is not necessarily like a doctor, I would say. Still in medical school, they may be there in that home for only 3 years. Well, with that being said, you may be able to give them a loan that gives them the interest that allows them to only pay interest only on the loan. However, if you decide to say, okay, hey, I think I'm going to be here a little bit longer. I'm definitely beginning to raise a family. I wanted to take roots before that loan, that interest rate goes up on them, meaning that, it increases, but maybe by a point or two. They look to switch over or refinance into a fixed interest rate, which basically across the board, like I mentioned before, stays the same throughout the life of the loan.
Okay. So then as a general rule, is it the case that the longer a person has a loan,
Mm-hmm.
the more likely it is that they should use a fixed rate?
I Well, I would definitely recommend that. Fixed interest rates, you don't have any surprises by year 8, year 10. You know that it is based on, that term, that full term for 30 years. So your monthly payment, short of your property taxes increasing or you changing out your homeowner's insurance, will stay the same.
So how much advance notice is a person given before the interest rate goes up, if you're doing a variable?
Usually they will, if you're doing a variable interest rate, usually they send out yearly updates on what the interest rate will be, or, and once it gets closer to that max out rate, so to speak, they would then begin getting notifications and calls even from that said servicer or lending company to change, to possibly look in and explore doing a fixed rate mortgage.
I'm sorry, did you say that you get the notification yearly?
You would get notification. You would get notifications closer to the time frame that the interest rate will be at its full power, full strength, its peak.
So if I take out a loan, I apply for a loan tomorrow, I decide to do and I think I said variable. I don't know the terms. Is it the same? Is that the same? Is that an arm? Rate?
Variable is adjustable, variable, same thing.
Okay, all right. So we had a little bit of a signal issue. Adjustable. So when people say an arm, are they talking about an adjustable rate mortgage?
That is correct. Yes.
All right. Okay. So I get a variable or I get an adjustable rate mortgage and I start paying on it, let's say March 1st. And am I going to get notification in June that beginning September 1st, the interest rate is this? Or am I getting notification in June that beginning January 1st of the following year, the interest rate is?
Yes, and actually, as a matter of fact, they usually adjust according to the year. So
Okay.
you don't have to worry about something where you close one month as being 2% and now it's 4%, 3 or 4 months down the line. They usually have a year increment time frame where the interest rate will adjust accordingly.
So, and so then this might be a little risky. Maybe it's not for everybody, so to speak, but could some say, hey, let me see what this adjustable rate mortgage is.
Mm-hmm.
Oh, it's 3%.
Mm-hmm.
And and then I just keep paying the 3. And then when you tell me, or when someone tells me, hey, 6 months from now, we're expecting you to go up to 5, couldn't I then just start reaching out and applying for other loan products or services?
Absolutely, absolutely, absolutely. You are not locked. The only thing that we ask as lenders when you start to make that transition to going to a fixed rate mortgage is that you've at least had a bare minimum of between 12 and 18 months of on-time payments with your existing mortgage.
Okay. Okay. And then am I punished, for lack of a better way to say it, by mortgage shopping?
No.
Okay.
Well, um, when when there's no such thing as a punishment as far as this is concerned. There are inquiries that in the process of looking around for a mortgage. There are inquiries that you will have, but I'm no credit expert by any means. Let that be known, but history has determined that, say, for instance, you're looking at a Chase Bank, you're looking at TCU, a Freedom Mortgage, or something like that, and you're trying to find the best interest rate. What it determines is that you are shopping for a house when every time that you have a credit pool, which probably would be within the term of maybe 30 to 45 days. But if you go and say, hey, I'm looking for a house, and then you run to a furniture store, say, oh, I'm looking for opening up a line of credit there, while in the process of trying to refinance a car or finance a car, then at that point in time, it's going across different lines of credit, which makes you appear desperate for credit. Just depends on the frequency of how many times you have your credit pulled,
Okay.
which as a result can have harder hits and hurt your credit score a little bit more, as in comparison to just looking in one category of lending or of financing in this case.
How much of a down payment is typically required?
Well, it's being product specific. If you do a FHA, the bare minimum would be 3.5%. Okay. Conventional is between 3 to 5%, but your maximum could be 20%. Or in some cases, if you do have the cash or the assets to help lower your monthly payment. It could be beyond that. If you are a VA mortgage person, or you're looking for a VA loan, there's no percent down on that for VA or USDA.
Sometimes I hear people talk about discount points. What's a discount point?
So discount points, just to understand a little bit, discount points are measured by the eighth of a point, 0.125. So say for instance, if the interest rate is a 7%, okay, but yet and still you want to be at a better interest rate overall, you can utilize discount points, meaning that you pay an additional premium for that said interest rate. So if you're saying, I want to go down to a 6.875, then you would pay whatever that cost of the uh, interest rate to actually lower your interest rate now.
Hold on,
You there?
we had a bit of a signal issue. So if you said if you wanted to bring it down to a particular interest rate, you would pay what?
You would pay an additional premium for that interest rate
So when you say an
at
additional,
closing.
when you at closing, so all right, an additional premium. So by additional premium, you mean you would pay more money than, so let's say the interest rate is 7%, and the expectation is that you're putting a down payment of 10%. Are you saying then that you might be able to go to the person or to the lender and say, if I pay 5,000 more, will you discount 2 points?
Yes. By paying that additional $5,000, if that's what it calls for, you would be able to acquire the interest rate on a more competitive interest rate, dare I say, by paying that additional cost at closing.
What's an origination fee?
The origination fee is what a portion of the closing cost that the lender requires to touch the file, from me having the conversation with you at pre-approval, all the way over, or actually, let's take a step back. I would say from the contract coming into the lending company all the way over to closing. That's the processing fee. Every hand that's involved with, the processing, the originating, filling out the application, to the underwriters, to the closers, that's what that cost would entail.
And when does the home finder find out how much the origination fee is?
The origination cost, if for a good mortgage loan officer or originator, they usually have a tendency to tell you in the beginning, can give you that information in the beginning. But during the process, there's a loan estimate that goes out to the client to show a list of fees that's associated with that. And your mortgage loan officer should be able to kind of walk you through that loan estimate to kind of give you the price of the different fees and explain to you in detail what those fees curtail, or what that means for you, how that money is being spent.
And is the mortgage broker paid based off of the origination fee?
Yes, that is correct.
Okay. And then is the origination fee negotiable?
Is the origination fee? Well, the origination fees for lending companies are not necessarily negotiable. You would actually have to go and check between two different mortgage companies, or banks, if you will.
So when you say you'd have to check between two different mortgage companies or banks, you're just talking about the process of the home buyer basically applying for credit or a loan through multiple lenders and then looking to see what,
Who has the best fees?
okay. And the points and fees on the transaction, do you get, does the buyer obtain that information when the mortgage broker comes back and says, hey, this is what I get, this is what I can get for you?
Yes. As a matter of fact, like if there's any additional fees, usually I go and I tell my clients, hey, this is what I can do at par, which basically means where there's no cost involved for having that interest rate. And then this is what I can do for you once with the additional discount points. And then, I kind of give them a um, a scenario of how long it would take for them to get that money back based on the savings that they have between the two interest rates.
So is there a prepayment penalty?
Um, Back in the day, there used to be prepayment penalties, but now across the board, there's a lot of products that are out there for the buyers that does not require prepayment penalties. So, say for instance, you start a loan and you're like 3 years into this loan, and you get a windfall to go that will be able to pay off the loan early. There would not be any additional added fees for paying off that loan early, which is really, really advantageous to the buyer.
It sounded like you said that there was a point in time when there were prepayment fees. Are you saying that now no one charges you a prepayment fee, or are you saying that now there are some people who will charge you a prepayment fee and there are others who will not charge a prepayment fee?
Well, I would tell you this. The products that NRL offers, the majority of those loan products does not offer or does not require that the buyer, if they pay off their loan amount early, require a prepayment penalty.
And when is the best time for a buyer to inquire about that type of
At
you know,
any point of time of the loan, at
okay.
any time of the transaction prior to close.
Now you may have touched on this a little earlier, but I want to make sure I ask the question directly.
Mhm.
Uh, how much time does it take for you to fund a deal?
Um, Funding, in the term funding, uh, it, it just depends on the product, or it depends on the purpose of the loan. If you're doing, say, for instance, like a purchase, funding can usually happen at close, whenever that time frame, that set time frame is, that has been agreed upon between the seller and the buyer. However, if you do a refinance, there is a rescission period that takes place at close, which gives, to avoid buyer's remorse. They give you 3 days or 72 hours to kind of make sure this is what you want to do before they fund that said loan.
Do you guarantee on-time closings?
I I put it to you like this: we work to the best of our abilities to go and meet the needs or the requirements of both parties, being the seller and the buyer. There are situations uh, that come about, whether it's from the property itself, the buyer, or potentially the seller. So we don't guarantee anything in this situation, because there are a lot of moving parts in this process. Um, but what I will say is that we do work diligently as a lending company and me as a loan officer to meet the requirements in order to stay to build better relations with both realtors and the clients in this situation.
Okay. Is the process for obtaining a loan for a residential purchase different from the process for obtaining a loan for a multifamily home or a commercial loan?
Um, I would say multifamily homes just depends on how it is that you're using it. If you're using it from the sake of it being an investment property, yes, there is a little bit more support, a few more supporting documents that we would need, as opposed to what you would have as far as a primary residence. However, if you're using a primary residence that happened to be a 2 or 4 unit property, 2 to 4 unit property, then it will fall under the guidelines of a primary residence. Does that make sense?
Yeah.
As far as commercial lending may require more assets, history of you owning commercial properties. Um, it just depends on the lending company and their said requirements as well, along with the investors.
At what point does the loan switch from being a residential loan to something different? Because it sounds like you saying, let's say on a single family, you're going to call that a residential loan. On a duplex, you're still going to put that in the residential category. Sounds like on a fourplex, you're going to put that in the residential category, assuming that the person, if it's me, assuming that I live there.
Correct.
um, at what point does it switch from or at what point is the classification changed from residential to something else?
Okay. It just depends on the product that you have. Like with a conventional, you can do it as early as 6 months. With FHA with FHA in this situation, I would say between 12 and 18 months.
I'm not asking the question correctly. So let's say I'll use a hypothetical to illustrate what I'm trying to say. So let's say there is a 9-family building,
Okay.
and I come to you and I say, I want a loan for this 9-family building, and
Mhm.
I'm going to live in one of the residences. Is that still going to be structured as a residential?
No, no, it
Okay.
will not. Because keep in mind, if you have a 9 unit facility in which you're looking to be a primary, that is beyond that scope between 1 and 4 as a residential. You
Okay.
would then, at that point in time, would need to seek out commercial lending of some sort, or a said company that will allow you to go beyond that 4 unit to go and be declared residential.
And so for you, or at least for your company, is the line drawn at 4?
Under primary residence household, the line is drawn at 4.
Now, and this is maybe a related question, but is the process for obtaining a loan for a home in which I live different from the process for obtaining a loan to purchase property that I plan to lease to others?
Yes, yes, it is. There are certain benefits that you can receive as it being your primary residence, and then a place that you, as opposed to having it as an investment property. In layman's terms, I would say that by having an investment property, you are looking at acquiring a property that is going to give you give you income, and its main focus is to actually have income in that property. Well, with that being said, what investors look at is the fact of you're going to have income generating, which would require a higher interest rate. You get paid, they get paid. So it's that's one factor. However, if you're saying, hey, I am buying a duplex and I would like to have it as a live in it in one side of it, then they still say, hey, even yet and still you're living in one side, they will give you discount for it being categorized as a primary residence.
So wait a minute. Are you saying that even though you'll classify it as a primary residence,
Mhm.
if there's 2, 3, or 4 um, homes within the building, I might still get charged a higher interest rate?
No, I'm saying that you will still fall under the category. If you're living in that said house, whether it's a quadplex, a triplex, or a duplex, you will still by living there still have share the benefits of it being a primary residence, which ultimately means an interest rate that's associated as a primary. Um, uh, but if it's one of those situations where you say, "Hey, I'm just buying this duplex or what have you, 4-unit home," and you have no interest in living there, but it's strictly for investment purposes for you to make money on, then yes, the lender or the investor that's associated with the product that you choose are going to hold you to a higher interest rate or premium.
What if I acquire the home and then I decide to move out and
Okay.
rent the home? Um,
Okay.
is there a requirement that I stay in the home for a certain period of time
Mhm.
in order to maintain the interest rate that I've been given?
In the conventional, they will require that you at least stay in the home for a minimum of 6 months. However, for FHA products, on the other hand, FHA requires at least a seasoning of 12 months, 12 to 18 months.
Seasoning. Okay. All right. Uh, does the process for obtaining a loan change if I'm self-employed?
Yes, it does. Just the requirements as far as supporting documents would be required. Instead of we're asking for W-2s and pay stubs from that said employer. We are looking at more so how are your assets? Are your assets? What do your taxes look like as far as being um, owning your own business?
What if I'm getting divorced from someone and
Mhm,
both of our names are on the mortgage? Can you
mhm.
help me get my soon-to-be ex-spouse off the mortgage?
Yes. In this situation, what would happen is we would first need to have the divorce decree because there's nothing that will allow us to move as lenders until everything has been finalized by a court of law in this situation. Um, what we would do is we would look at let's just say the primary in the situation, which would be you. Okay, we would look at you and say, hey, do you have the qualifications to be able to, or the ability to repay this loan on your own? That will consist of your credit, your income, your job stability, whatever that may be, and then the assets to make sure that you be able to close the loan and then sustain that loan in the event that anything happens. And then for your partner, which is maybe an added benefit, we would then determine, do they have the ability to purchase a home under those same categories, which are your credit, your income, your job stability, and then your assets.
It's one of the biggest challenges that many of my domestic relations clients face. They get into these situations where they are able to acquire a house because one person had income but didn't have very good credit,
Mhm.
and the spouse had the higher credit score but didn't
Mhm.
have the income, and and then when they split, you know you, they run into this problem where they feel that, or where it's the case that one can't get refinanced, and I see that that happen a lot, and it's probably the product of the idea that both people were needed to even
Mhm,
obtain the house.
mhm,
Um, and sometimes I wonder whether it's a sign that the couple acquired too much house in the beginning.
mhm,
Uh, but it's very difficult to have a conversation with people, about that kind of thing, because at the time that they're acquiring the house, they're a unit. And so they're thinking, well, why should we get less house if we have the ability to get more house? And then what ends up happening is the couple is faced with a situation in which they have to sell the house
mhm.
because they can't they can't because they can't get one person's name on the mortgage. And so I see that a lot.
Mhm. Well, and to your comment, to your point, um, when you acquire the house, okay, one thing that especially with my first time home buyers, they should be still working on those items. You
Mm.
know, unfortunately, a lot of people, when they acquire the house, they're like, okay, we got the house, we're done. Well, you have to be prepared in all situations. The only thing that we do is measure the amount of risk that you can afford. So when you acquire the house, as what I advise my clients is to continue to work on your credit, continue to work on your income, continue to work on your assets. As long as you're living, there's always a probability that something can happen: death, divorce, um, you know, other extenuating circumstances. The loss of a child. There's always things, so you should always be prepared to make sure that you can make a shift at any given time. So for those who are listening, don't stop um trying to work on your credit just because you've acquired a car and then houses. You need to be prepared to be independent as well as be better as a unit. So
But death or the loss of life versus the loss of marriage, those are two different unforeseen circumstances. I suppose one could make the argument that one of those isn't actually an unforeseen circumstance. I mean, you are going to die. Uh, but the but in the event of a death, the other person is still paying on that mortgage, correct?
that's true.
Okay. Um,
If they Well, let me clarify that. In the event that both names are on the loan, then it is on the burden of responsibility is upon that secondary client
okay.
to
Okay.
pay the loan. Now there are certain things that are that are made in place, or you can always talk to an insurance agent to get life insurance to kind of protect yourself in the event that there is a loss of a loved one in that situation. You can, and they would be able on your behalf to pay off that loan amount, which you would then own the house scot free, kind of free and clear of any debt. But yes, it's a situation that happens all the time, but that goes back to my original point of being prepared in all circumstances to go once you go and enter this house. The normal term for a mortgage is about 30 years. So a lot can happen in 30 years, let alone 2 minutes. So yes, we do properly educate. When I do home buying seminars for clients, I do properly educate them to be prepared for not only getting the house, but keeping the house as well.
I said something earlier that I may have been assuming something that I should not have been assuming. Uh, I gave an example where one person has a high or a relatively higher income, but a relatively lower credit score, relative to the spouse.
Mhm.
Um, and I assumed that the lender uh, is looking at those two things and kind of taking the best of each person, in evaluating the package. Is that what actually happens? So, in other words, I assume that I come to you with um, a 600 credit score and $50,000 a year in revenue, and my spouse comes to you with uh, an 800 credit score and $20,000 a year. Are you looking at us and saying, okay, these people have an 800 credit score and they have 70,000 in revenue, and we're going to base what we're doing off of the best of these people,
Okay.
or are you evaluating it in some other way?
Okay. So with that, when we look at everything, the only thing we do is measure the risk of everybody, and that's from the worst case scenario. Using your scenario or your example, I would say the 600 credit score is what we're going to base it off of. So we're not going to base it off the 800. We're going to go by the weakest credit score, the weakest medium or middle credit score that they have.
Wow.
So if you're at 815 and the other person is like 671, guess what? It's going to be the 671 that we're going to go and base that off of. If one person has $20,000 and the other person has $50,000, well, yes, we can combine the assets to make sure that not only will you be able to accept the closing costs, but just in case you'll have reserves, just in case something goes south, meaning that you the loss of a job, the loss of a loved one, or something like that, to maintain yourself or the ability to repay that loan.
It's interesting, and this is perhaps the cynic in me, but it sounds like the lender, and I imagine that this is probably industry wide, but I suspect that there's also room in a competitive marketplace for the philosophies to be different on this. But it almost sounds like a lender might say, we're going to assume 70 because we want to be able to give you this money. In the example, 20,000 revenue from one person, 50,000 revenue from the other. Um, the credit score in the 800s from one, the credit score in the 600s for the other. It almost sounds like you're saying, we want to be able to give you this loan, so we're going to assume 70,000, but we want to be able to charge more in interest, so we're going to assume the lower credit score. Because if we assume the higher credit score, we've got to offer you, uh, we're likely to offer a person with an 800 a lower interest rate than a person with a 600. So let's give them the offer based on the money, but let's set the interest rate based on the credit score.
Well, I wouldn't say that, because what we always do is assess the worst case scenario. And it all comes down to who is less likely to have that. It's two sides of the spectrum, but honestly, we also look at the fact of, hey, as a unit, what's the likelihood that we're going to get our money back? And we always have to assess that couple in this situation as the worst case scenario for us. So does that involve having the higher interest rate? That may be based on the worst case scenario. Money and assets that come into play, yes, it plays a part, but mostly the credibility of that client or that unit lies solely on the weaker of the two.
But when you say you have to evaluate it from the worst case scenario, while at the same time saying you're going to assume the highest amount of revenue, um, those two things don't seem uh, in alignment, shall we say? Because if you were going to consistently, if you and I realize, again, this isn't, I don't know that this is a decision that you make. I recognize that this is a your company's decision, and it's probably a decision that's being made across, the industry. So this isn't really an argument that I'm having with you. It's probably me uh, being critical of an industry philosophy. Uh, if if you're going to say we've got to assume the worst, but then you say we're going to take the whole pool of income, those two things aren't consistent, because what would be consistent in my mind, what would be consistent in assuming the worst, is to assume the lowest income of the couple. But you can't do that, because if you assume the 20,000 in the hypothetical that we just went through, if you assume the worst, which is the higher earning spouse is somehow not able to earn, and now we have to use the lower earning spouse. If you assumed that, then you'd be looking at a $20,000 earner, and then you couldn't put out the loan. So, and this may just be one we have to disagree on.
Yeah.
I understand your position. I don't have a dog in the hunt. I just look at it and say, okay, they want to give the loan, so they're taking the most money possible.
Yeah.
They don't really want to give you a low interest rate if they can help it, if they can get away with it. So we'll base it off of the lower earning person, particularly if the 600 scorer is the highest revenue producer.
Okay.
I mean, if the person with the 50 in our hypothetical, again, one person's got 50,000, one person's got 20,000. If the person earning 50,000 also had the highest credit score, if I were that person, I'd say, hey, wait a minute. You can't base us off the lowest earning credit score. I may not even need her to get the loan if it's me. How can you look at my 50,000 in revenue and my 800 credit score and say, nah, we're going to base you off of the 6 something?
So I think what we need to do is just definitely step back and just take a look, utilizing that scenario. If
Okay.
you're making $50,000 and you have a 600 credit score, you're going to be based on a 600 credit score, as opposed to the person that has the 820 in that case and make $30,000 a year. You know what I mean? So
Yeah.
the income does not have any. Well, it does have a part in it, but it is once again the ability for that person, the calculating the risk of that ability of that person who has a 50,000 to be able to repay that loan. Now, what I also will say is that even yet and still, companies have their own guidelines. There are investors that require these set terms that give us the money to turn around and give to the buyer in this situation. So it's not necessarily a company-wide thing, as we do have certain guidelines that we agree upon as a company to lend, but it's also mandated by the investors. Now, the beautiful part about this is that with NRL Mortgage, we don't have any uh, additional guidelines that we read straight from what the investors who give us the money to give to you go for. So in this situation, in the event that the person has a 600 credit score and a $50,000 income, as opposed to the person that has an 800 credit score and a $30,000 income, we are still going to base financing and the interest rate off of that individual who makes the most but has the lowest credit score, because they are the less likely to pay, even though they make the most money.
Okay.
Yeah.
Okay. Uh, what is a closing?
Okay. A closing is the festive part of my job. It's one of the enjoying part, the enjoying uh, factors of what it is. This is where the underwriter has found all terms and conditions to be good with the ability to repay for the borrower, and they have now given the final approval saying that, yeah, they are clear to close. Closing takes place with the title company, where everything as far as the property on the property side has checked out, which means that they're title, they have to come back with a clean title. There's no liens or judgments against that title, and all of the documents uh, of the loan and the title company are in harmony. So the buyer and the seller will sit down, in some cases, will sit down at the table along with their realtors, and they will come up and sign the final documents, where the money that's being loaned by the buyer is going to go over to the seller for the proceeds, minus whatever it is that they owe, or if they don't owe anything, the full check. And then in exchange for the keys or the rights to the property.
Do I need a real estate agent?
To answer that question, um, a lot of buyers, first-time home buyers, um, it would be highly suggested that you do. And I'm going to tell you the reason why. Because there's terminology. It's not like you're going to a local store to go and buy a bar of soap. There's a lot of terminology, and there's a lot of factors that go into the home buying process, from your side as well as the realtor, the realtor that supports you side. They can be able to negotiate terms and conditions that the buyer wouldn't even necessarily think about. So having a buyer, when my first-time home buyers come, I do ask, do they have a realtor? If they have experience in negotiating terms and things of that nature, then more power to them. Hey, it's perfectly fine. But if there's no additional added cost as a buyer for you to have a realtor that's going to speak on your behalf and negotiate on your behalf about the terms and conditions of buying that said property.
When you say there's no additional cost to me, I hear people say, all right, I hear these numbers. I hear people say, well, it's 3% for the buyer, or it's 3% for the seller. I hear some people say, well, it's 6% to the seller, because the seller gets the 3% that the buyer was going to get, and it becomes a little confusing. Can you speak to any of that, or is that outside of the scope of your duties?
I would say this. When everything, the 3% and the 6%, that is definitely outside of the scope of my abilities. And I don't, and dare I say, I'm very cautious to speak on such of what I personally know. What
Okay.
I will say, as a first-time home buyer, and for all those first-time home buyers out there, when you talk with a realtor, you will not be held accountable for paying a loan company the closing costs and then turn around and paying a realtor.
Do you have any thoughts on the question of whether a person uses a lawyer rather than using a real estate agent?
I have not had any transactions where a lawyer was involved on the buying side of the table. What I will say is that if that said lawyer has experience in negotiating terms and conditions um, in transactions for buyers, then there should not be any problems. And I say that with the air to the air of caution. If that lawyer has has been licensed or deemed as such from a higher jurisdiction to negotiate terms and conditions of a loan, yeah, by all means, you are free to use that person. But I have a tendency to stick with the experts in this situation. Realtors is who I deal. The majority of realtors are the people that I deal with. Other than that, it will be a for sale by owner. And even with that situation, the realtor on the buying side for you first time home buyers is going to be beneficial, highly beneficial for you.
Fron, thank you for taking a few moments and kind of helping me and us navigate through some of these challenging issues related to mortgages and mortgage brokers. If I or anyone wants to try to reach out to you and find out more information about what you're doing, what social media could we use to access you?
Absolutely. And thank you for having me once again, Mr. Moore. It has been a privilege to speak a little bit first time home buying, lending. This is definitely a passion of mine. You can reach me via Facebook at Fron, Fron, like my name, Finance with Fron Neal. That is my Facebook page. I also have an Instagram page that holds the same title, Fron Finance with Fron Neal. You can also email me at fron.neal@nrlmortgage.com, or you can reach out to me via cell phone 317-531-3000.